Good morning, everyone. Thanks for joining this morning's webinar. Sorry if you can hear the church bells right behind. I don't control those. My name's Magali Neve, and as you've just seen, I manage Switzerland and Austria for SS&C Intralinks, and I'll be hosting today's panel. SS&C Intralinks is a global leader in technology services, supporting capital markets transactions, including asset sales, mergers, fundraisings, and reportings. Just to give you an idea of numbers, approximately $1.8 trillion in global capital market deal flow gets executed on our platform. The last 12 months have been really fascinating to look at from a deal maker's perspective. For Q3 2021, we're actually predicting M&A deal flow in real estate to fall greater than 10% compared to the same period last year, and on a quarter-to-quarter basis as well. Today, we've assembled a panel of experts to share their guidance and views on the current real estate landscape, with somewhat of a European, and I do include the UK in this, prism. On our panel today, I give you, in alphabetical order, Roland Fors, who heads the European Real Estate Finance for Addons, which he joined in 2013. He successfully built up and developed the debt investment activity of Allianz on a pan-European level, now reaching 11 billion euros. Prior to that, Roland worked within European real estate lending for German mortgage lenders such as DSL Bank, West Immo, and Hallerber out of Germany and France. Neil Slater is the global head of real estate and deputy head of private markets at Aberdeen Standard Investments. Neil joined in August 2011, leading a multidisciplinary team responsible for debt investment, where he managed ASI's real estate lending platform, as well as fund, tax, legal, and financial structuring for real estate business and debt financing across different asset classes. Most recently, he spent over 4 years as CEO and representative director of ASI in Tokyo, building and leading their asset management business. Neil spent over 6 years at Man Group, where he had responsibility for a multi-billion USD private debt, capital markets, and OTC derivative book, in addition to working across geographies to structure and deliver liquid and illiquid alternative asset funds. Michael Wagenhofer heads the international desk in the Vienna headquarters of Arnold Investment, a leading European broker with offices in 8 countries, where he oversees cross-border investments. Prior to that, he managed the Hungarian team within Arnold Investments, and his team covered transactions in all types of asset classes: residential, office, logistics, retail, and hotel in DACH, Southern Europe, and CE regions. Last but not least, Larry Young became head of the International Investment Group at BNP Paribas in January 2018. After spending 17 years in Paris, Larry is now based in London. His team has transacted over 15 billion euros worth of investment deals since 2013. A key part of the role is also cross-selling with all parts of the BNP Paribas group, notably wealth management and corporate investment banking. Prior to that, so before running this team, Larry focused on the French investment market, working on some of the largest deals, bringing in new investors from Middle East and Asia. I just wanted to remind you before we kick off the discussion that you can all submit questions via the chat, and we'll do our best to answer them in the allocated time. So don't hesitate as you go along to ask us questions. The first question we're going to start with is a very original one. How severely has the commercial real estate market been impacted by COVID and the potential extensions of work from home policies? As we can see, some of us are actually at the office, so things are changing a little bit. And Neil, would you like to give us your take on it?
Yeah, sure, Magali, thank you very much indeed. It's great to be here today. And as you said, I'm in the office unusually. So certainly been a very interesting 18 months. I mean, you asked the question around to what extent has commercial real estate been severely impacted? And, you know, from my perspective, severely always sounds very negative. So I would say rather than being severely impacted, I would say it's been significantly impacted in 2 areas. One is the economic aspect of the crisis and how that impacts real estate as an asset class. And the second element is the structural acceleration that I think COVID has developed and evolved for real estate. So I'll just touch on each of those very quickly. then obviously hand over for other views from people. But I think first and foremost, we cannot forget and get away from where we are from an economic perspective. Real estate is highly correlated to the macroeconomic environment. You only need to look at where government bonds are. Let's remind ourselves that 10-year govies, what are they? 10, 12 basis points at 10 years in Japan, France, negative Germany, 1.5 US, about 80 bips in the UK. So first and foremost, on a relative value basis, real estate as an asset class, irrespective of how COVID has played out, continues to look interesting. We've seen some of the widest yields for real estate since the 1940s in some sectors, particularly retail, but generally across the board. And at the same time, we've had a lot of government money, which is going into the economy, supporting various sectors in which we invest. So I would argue that putting all of that together, the wall of money that's investing in real estate, the current level of government and corporate bond interest rates, which are very supportive to real estate, together with the governmental support that we've seen economically, has actually dampened the impact of COVID. We also have to bear in mind that there's not as much debt in the system as we'd seen previously. Now that's the economic angle, but I think what's really fascinating is the structural elements within real estate. So I think COVID has really accelerated the changes that we had seen coming through in the living space, in retail, in online shopping. And that's why we're seeing such a focus on money chasing, living, residential, logistics. And I think there's a lot that's going to impact, not necessarily severely, but impact real estate over the coming 18 to 36 months. A lot to happen in the office space, a lot to play out in the retail space, and a lot to play out on both the equity and debt side, I think, of the asset class.
Michael,
I think with that, am I handing over back to you, Magali?
Yeah, absolutely, but that's fine. I'll do it.
So thanks, Magali, and thanks, Neil. Just on our side, so what we've seen is, last year, overall investment volumes were obviously down, but not as much as we would have thought, because they were down about 23%, 220 billion euros. So that's investment coming into European real estate. And what's quite interesting is the actual domestic part was down about the same amount as the international part as well. So you still did have international investors able to invest with the very despite the very tough travel restrictions everywhere across the globe. But of course, that was the international side. It was very different with locations. So, for instance, Asian investment was down over 40%, whereas European cross-border investors, so Germans investing into France or the UK or vice versa, for instance, was only down close to 20%. Agree totally with what Neil was saying. A massive impact and a massive change in the market, but not as big an impact in investment volumes as we probably would have thought beforehand. And when you look at the amount of funds wanting to get into real estate, and also the reasonably healthy debt markets as well, it's actually not gone down significantly. But what has definitely happened is a shift on what everyone wants to buy. Every time we go to a sort of classic investor that used to look at office and retail, hotel markets, and probably a little less so on some of the logistics and residential markets, that's completely shifted. And now, due to the massive impact of COVID, there is that change, and huge weights of money into logistics, huge weights of money into, I'd say, new asset classes that we're all slightly scrambling to kind of keep up with, life sciences, data centers, which are linked to obviously the effects of COVID, the effects of home working, the effects of online retailing. And I guess what's going to be interesting is now we're coming out of, hopefully, sitting in the UK especially, and hopefully everywhere else coming out of this pandemic, where investors will start shifting back. We're seeing retail, for instance, some deals happening now. Hotel markets where volumes were, I think in 2019, over 20 billion, went down to 7 billion, but now there's a lot of money wanting to chase those asset classes. So I guess in general, a drop in the markets, of course, not as much as we thought it would be, but then, agree totally as what Neil was saying, a complete shift into what investors are looking at.
And do you think from a European standpoint that there are these several insolvency moratoriums in place and they're going to be sunsetting at some point, right? How is this going to cascade and impact real estate? And is it going to lead to a rise in lease terminations? Roland, what's your point of view on this?
Well, what we have experienced in the second part of the pandemic, in the lockdown period, starting in 2020, that effectively there is a huge variety between the European countries, not only in the commercial law, but also in the insolvency law. So it is quite a colorful mosaic that immediately had an impact in the conversations between landlords, tenants, and lenders at later stage. And there were some interesting scopes. So you had countries which are known to be more commercial, market oriented, and borrower friendly, which all, like Poland, which all of a sudden were impacted by measurements retroactively suspend rents back to March 2020. So their cash flow immediately dried out. Of course, that provided a big challenge between landlords and tenants, but also to lenders as a result. You had other countries, in France, for instance, there was a massive support immediately kicking in favor of landlords, but also tenants, of course, that facilitated those conversations. There were only very few countries which haven't been affected at all, like Sweden, but there was a big variety of impacts to be distinguished between the European countries. Of course, what then happened after the first wave of lockdowns is that then landlords were requested to sit down together with their tenants after having bridged this first very delicate period of lockdowns, where I think everybody was quite accommodating because everybody understood that this needed to be treated comprehensively. But then what happened I would say in the second wave is, and still occurs until now, are the conversations kicking in between landlords and tenants about the future lease agreements. Of course, there were still, and there are still legally spoken rents in place. Nevertheless, economically, what has started, especially in the retail sector, is that that conversations kicked in concerning the future scope of those leases. So we are talking about rent-free periods, step rents, rent levels, affordability of rents going forward, the split between base rents and turnover rents. How do we measure turnover rents if in the future there will be more models of click and collect? So as Neil already stated, those discussions, I think, especially on the retail side, would have been kicked off anyway. But there, COVID was clearly an accelerator, and those conversations are far from being terminated. And we expect this until it's going to be settled and balanced on a new, I think, rent level to continue to occur in 2021 and 2022. All this, of course, had also an impact on the lending framework. But maybe, Michael, you want to share your views on that particular aspect?
Thank you, Roland. Just wanted to add a couple of points to your rental and landlord summary, so to say. So there is, yes, what you mentioned in Poland, there was an example that stuck out quite a lot. I think in general, obviously every landlord and every tenant have a different discussion, but I think what sort of framework that did crystallize was a sort of a trade-off between either shortened or furloughed or really reduced rents in exchange for extension of leases. So basically, you give them 6 months free rent or very reduced rent, but the tenant agrees to then more or less make up these 6 months at the end of his existing lease. Furloughs or signing waivers of termination, and like I said, every discussion is obviously a little bit different, but that seems to be the most pragmatic approach that has sifted through the market in most asset classes. Considering also, we're talking commercial real estate, where there's different discussions in sectors of retail, for example, or hotels, where it does make a fundamental difference if the unit, the property has to close down fully or could operate like offices. I think I didn't see any large reductions. Most office tenants kept on paying kept on paying their rents, even though they didn't really use it at the time. In hotels, for example, we have just one example here in our hometown of Vienna. We saw we had a hotel for sale that we actually sold as well, where the tenant, a respectable, well-known German chain, just chose to not pay anymore and basically let them be sued out of, didn't engage with the landlord in any sort of agreement, and maybe overestimated their bargaining position, but eventually were removed from the property. What I also see is that what I hear from my clients when they're evaluating now transaction and acquisitions, new leases, and how do you value market value for rents if you have a very a lack of comparables. So for a year, it's not like no one has signed a rental agreement, but it's much less, obviously, and people are having difficulties evaluating existing leases and also going into future leases, because you don't know where you stand. And lastly, maybe something also as an effect to the insolvency moratorium, we, at least in our markets, we didn't or yet are waiting to see the so-called fire sales. It hasn't really landed. We've been waiting or expecting it for at least the end of last year. Discussions were at the end of 2020 will come beginning of 2021, but as these moratoriums keep getting extended, none of these are really happening. Obviously, there's some larger portfolio deals. For example, in the hotel market, that is where everyone is kind of waiting until government subsidies run out, and then some landlord will have to sell.
Thanks, Michael, for that. I guess this leads to the next question, which is, from an investor and lending perspective, is the pipeline for new projects right now attractive? So are there asset classes such as residential that we were saying are doing really well? Where are the windows of opportunities now? And what's the short, long-term investment strategy for capitalizing on those? Neil, what's your take on that?
Yeah, thanks. I mean, it's such a fascinating time, I think, for all sectors, and a couple of points that are important when I'm thinking about, the asset class generally is where are you in terms of relative value of the asset class, relative value of sectors, where are you in terms of risk-adjusted return, and where are we in terms of in terms of the cycle as well. And if you think about what we've just been talking about, we've just gone through a period of a phenomenal period where you'd have rental collection in some sectors down at 25% and others, resi logistics at 100%, at a time where there's hundreds of billions of dollars of dry powder chasing real assets, given where govies are. And so from my perspective, there's absolutely opportunity. Larry mentioned some stats in terms of transactions last year, but first and foremost, you've got to look at where is money flowing into, and it's flowing in rapidly. It has been for a period into resi, into the living space, into logistics. And you've got to take a step back and ask yourself, to what extent do those sectors maintain and sustain the value that you're looking for? So let's take resi as an example. In Europe, for a reasonable portfolio, let's assume you can get 3% income, 5% total return with limited risk. Sounds great, but you've got to find the stock. You've got to do forward funding. You've got to develop the assets. You've got to stabilize the portfolio. And that takes a while to build up. And so there's so much money chasing that. Logistics, Larry mentioned logistics. We've seen a number of projects recently where there's so many bidders for, really good assets, yields really compressing as a result of the wall of capital, and also the kind of the technology and the accelerators that we mentioned earlier. That to what extent do you then start saying, well, has retail been oversold? Do we think that this is the right time today to be investing in offices, or do we think that over the course of the next 12 to 18 months, as a result from work from home, as a result from environmental impact, there's going to be further change in that marketplace? So we absolutely see opportunities. We invest across the board. But what I find really interesting is essentially looking at the relative value position across sectors, across some of these new areas that we've been talking about, data centers and more operational aspects of real estate, and asking yourselves, does this make sense in terms of the covenant income and asset fundamentals before making the investment? And the other thing I'll say, and then I think it's a good time to hand over to Michael, is, the great thing about real estate is you can come in at different points in the capital stack. So, we can sit here and say, well, retail's still looking like it's not in a great place, it's got further to fall. But you could be going on there on the debt side and lending against retail assets, where you might have the view that valuations have fallen down so much. Actually, the yields you're getting on the debt side is starting to look comfortable. So there's a lot of different opportunities. And, Michael, you might want to come in and provide a view on that.
Sure, thank you, Neil. Mirroring some of your earlier points, I mean, yes, the obvious, still a year ago, I said it, and I still say it. I don't want to say there's clear losers and winners in terms of asset classes, but then again, there are. Yeah. Residential, definitely logistics, supermarket, like actually what we call system relevant, so lockdown resistant retail properties. And also what you mentioned in terms of dry powder. Yes, there is that increased competition for sectors, because basically everyone who was not in resi, not in logistics, not in supermarkets is now in supermarkets. So the traditional powerhouses of these sectors that have been focused on that solely for years, decades even, built up great portfolios, now are complaining that everyone is chasing after them. It's getting harder for them, and sometimes even they feel they're being priced out of the market, and taking a step back and say, well, we're looking after our own portfolio, to maybe looking. It's a nice problem to have, yeah, to have to be in the sector that everyone wants to get into. But in general, obviously these three asset classes, let's say, be seen compressing yields, and obviously therefore rising prices, and therefore for traditional players it becomes a little less attractive, even because you say now everyone is playing on my playground. In terms of office, for example, we see core office becoming even more core. I mean, 2 years ago I wouldn't have imagined that how dry something can become, or at least in terms of wish lists. Data centers, I've never had so many discussions about data centers in my life as in the last 15 months. A lot of Asian investors who were, especially in the large capital cities, very, very prime properties, very large players in the let's say 5 years, 10 years before COVID, have been taking a step back and have been going into, or pivoting into debt investment rather. But we saw also a couple of first deal tickers. Some Koreans especially are back, and especially because it's also the traditional original, let's say, background of our company is multifamily resi. that has risen strongly, and even in markets where it wasn't so popular, or due to legal environments. For example, CEE has a very high quote of condominiums, so you didn't have that product there, but now it's being built also because developers fear that people cannot afford to buy, so they will have to rent. And in an underdeveloped market like Czech Republic, Hungary, there is now built to suit resi.
I think that kind of leads nicely into the next question, which is on, reviewing investments from a due diligence perspective. Do you think there's now a unique valuation methodology that's kind of emerged during COVID? What are we focusing on when reviewing these investments? Michael, if you also want to kick that off.
True, yeah. Gladly. So what has been happening even before, but obviously picked up, is everything is becoming, or has become, in terms of due diligence, aspects of due diligence has become even more digital. Obviously owed to the fact that there were travel restrictions for, was it 3 or 4 months, basically could not travel anywhere. So investors were saying, we cannot underwrite if we cannot visit the property. Brokers and also sellers were getting creative with, FaceTime views of properties. The broker is walking with the phone in front of him. That might work for smaller properties. So everything that still requires a physical presence, basically technical due diligence, site inspections, initial site visits, that had to be delayed and put off. But until you finally get to an LOI, and then you get into exclusivity, and you start your due diligence process, everything is now digital and takes longer. For example, we just last March, in basically the week before lockdown, we had a final negotiation on a property where a client of us, that was the last week we could travel, so from Germany came to Vienna, was negotiating here, and already with some foresight said, I want to insert a COVID clause. Back then, it was 2 days away from the first lockdown being announced. It was, you could see the writings on the wall, but it wasn't really yet to be. It was a surprise when it came. And I remember we were talking with him. It's like, are you sure about this? Is this going to be? Do you think that's necessary? So I want it in there. A week later, he turned out very, very smart. So everything has been affected in terms of timeline, especially. If you don't know, banks are taking much longer for financing. I know of banks who until last fall didn't receive investors in their offices, so everything had to go via Zoom. And coming back to this and going over 3 times. And another interesting point that I think then Roland will possibly pick up on is what we saw is the rise of ESG requirements or aspects in large scale transactions. So, and I do believe it's not a coincidence, because everyone was, so to say, stuck at home, having to analyze their books, having to go analyze basically every step of their operation. And therefore everything ESG related that was a little, we don't have to pretend that it wasn't there before 2020, but it picked up rapidly in 2020. And now not everyone, but lots of people are saying, well, is it ESG? Do we have that? What kind of, so that I think is related to the industry having a bit of a breather in a way. It wasn't a comfortable breather, but it gave us an opportunity to reassess models, to reassess assumptions, and basically rethink everything that we have been doing and how we will go about it in the future.
Roland, over to you.
Yeah, absolutely right. Again, the topic which is not principally related to COVID, but where COVID was, providing some sort of acceleration. Why is that so? I think more and more investors, such as Allianz, are aiming to significantly reduce their CO2 exposure in their investment portfolio. And investment portfolio now increasingly also includes the debt positions, not only the equity positions. So that means that if you want to reduce your CO2 exposure also in your debt portfolio, you have to start measuring it, you have to assess it, and you have to collect data in order to do so. So collecting data concerning energy consumptions and CO2 emissions means that is becoming an indispensable part of not only of your initial due diligence, so collecting those data points, agreeing with your borrower on the format on which basis they shall provide you those data, but also on an ongoing basis during loan life. Energy data, the collection of energy data nowadays has become more and more also in the lending space an indispensable part of due diligence. Why is that so? It is yes to address the investment KPIs of lenders, but I think it's also to address a mutual interest, because in the long run, I think the energy efficiency to be addressed and to be complied with is also ultimately, affecting the probability of relatability in a building, the aspect of a refinancing risk from a lender perspective. This is not, it goes far beyond just having a green label. This is also the assessment of the S part of ESG, so the social part, which came much more to our attention during COVID. So the health aspect of a building and a space, of an office space, the social part of well-being, the flexibility, the community space, all those aspects which came much more lively to our attention during COVID, because we had to work from home for a lot of time. But I think this is an irrevocable development that has been again accelerated by COVID. ESG has become from, I would say, a level of nice to have to a compulsory, to a mandatory investment KPI also in the lending space.
Roland, this is also one of the questions that was asked, and I think you really kind of answered it by saying, does it add any value to the investment decision or asset valuation? I think the answer is yes, right?
Yes, because it affects the probability of a tenant staying in the building. It's as simple as that. It affects the refinancing risk, the long-term investment risk, not only for the sponsor, the equity holder of a position, but also for a lender. Don't expect, let's say, an unmodern, unflexible, and completely ESG uncompliant loan to be easily refinanced in a period of 3, 5, or 7 years time. So it is really an aspect that we already perceived as equity holder in our own real estate portfolio, but it is clearly a must-have now, increasingly kicking into the debt space.
Neil, what's your perspective on this?
Yeah, I mean, I completely concur. I think I've got a very strong view on this, which I think this is going to be one of the biggest impactors of valuation over the next 5 years. And I think that, firstly, to Roland's point, absolutely, it's going to become, for want of a better word, commoditized. This is going to be just something that everyone does, focusing on particularly environmental, social aspects. Is an asset class, we are 40% of carbon globally within the built environment. But I think what's really interesting is that we are seeing occupiers, tenants, customers making decisions now about their office footprint, not just based on a post-COVID work from home positioning, but also actually based on the environmental aspects of the building. I think that in the short to medium term, those types of decisions will start to play out on valuations, because if you're holding assets that are expensive from a carbon perspective, you've got to ask yourself, how can you develop or regenerate, reuse those assets in a way that has less of a carbon impact. And if you can't, you could find yourself in a position where the valuation of your assets are impacted materially. So I actually think this is going to be really fascinating for the industry over the next 3 to 5 years, and particularly in the office sector.
Thanks, Neil. The next question is specifically for Larry. If you could provide an overall view of your current pipeline and whether there's an imbalance between capital ready to be deployed versus available investments.
Thanks, Magali. So in terms of the current pipeline, we've got about 15 billion euros of sales out on the market in terms of investment deals, where we're generally strong at BNPs, especially in the German and the French markets, although we have obviously good teams across Europe, and that's a decent jump up from this time last year, because obviously May last year, everyone was going into this well into the pandemic. A lot of deals were falling out of bed, and generally in the investment markets, the MIPIM is quite an important timing where people get deals out, and this would have been a sort of a key point. So there's quite a bit of stock now coming out. I think investors have got more confidence to put deals on the markets, fairly well split between different asset classes. I mean, there's a fair bit of office deals out there, and I guess just to comment on the office market, I think what we're seeing in the core CBDs for long lease buildings, or even some small sort of value add projects, is completely different from what we're seeing in some of the more tricky suburb locations. We're seeing prime yields in Paris and Berlin, at extremely low levels, and a lot of competition, whereas more tricky locations, we're seeing deals getting stuck. In terms of the imbalance, I'll come back to what's been said a few times by everyone on the panel. I think that this imbalance of investors wanting to get into markets that are a lot thinner is still a tricky thing. I mean, we had some quite good stats where we did some surveys of the top investment products that people or investors want to look at. At the top, we've got logistics. So logistics is a big market. We've got big teams, and it's now roughly 15% of the investment volume. So it's a well-established market. Although, like Neil mentioned earlier, there's some deals out on the market. There's some big portfolios where you've got 20 or 30 bids for portfolios over 900 million euros, and that's just potentially something that's not sustainable. However, the other asset classes behind logistics are retirement, co-living, BTR, student, healthcare, and like we've mentioned before, we understand totally why investors want to get into these assets. The problem is, can they find them? There's just not enough liquidity to find them. So, as and on top of that, pricing has got so expensive that the returns are just not there. So what we're seeing, in activity, and also our pipeline of sort of deals coming out, is some more retail deals, some more hotel deals, some of these other asset classes that were so badly hit, and there is some appetite and there are things happening. You've seen some big deal recently, was out in the press with Unibail in Vienna. There was a big deal under offer on the retail side in the UK as well, with Hammerson and Brookfield, that was out in the press. So there was a number of these deals that are happening. But I guess the main volume we're seeing is still in the big office space, but for centrally located buildings, long leases, like the MOD deal in London that we saw out in the press as well recently, that sort of deal, and that's probably where we're going to see the most, or the highest investment volumes coming through, as well as just as the other people on the panel were saying, potentially the shift back from these asset classes that you just can't get your hands on to others that where pricing has come out. So yeah, that's a sort of overview of what we're seeing. And probably one last comment is, the markets are recovering with the COVID situation. UK definitely seems to be recovering quicker, and we're seeing a lot more larger deals in central London that are either under offer or coming out into the market, just because we're now pretty much out, whereas some of the continental European markets are and will probably take a little bit longer, and landlords will very much wait until investors can properly travel before pushing deals out onto the market.
Thanks, Larry. I guess it's interesting to think that the UK is a bit more forward on that matter. In terms of the fear in rising inflation being a huge issue, given stimulus packages and artificial support mechanisms instituted by many governments, what does this actually mean from a CRE investor perspective? Neil?
Yeah, thanks. There's quite a bit that we could probably talk about on this. I think it's a fascinating topic. And the first thing I think about is, well, where is the inflation? Where is real inflation? And there's a lot of talk about it. But the reality is, real inflation is, not yet here. And if you go back, I mentioned earlier some very simple stats on govies. What did I say? 10, 12 bips, 10-year France, negative Germany, 10 bips Japan. Okay, the US I think forward rates are looking up to 1.5 today, and maybe going out to whatever 2%. But first and foremost, I don't see it as an immediate and present danger, and people can tell me I'm wrong on that. But yes, if you're a long-term real estate investor, you've got to think about the impact of inflation. Now, what I would say about that is that people will often say that real estate's a hedge for inflation, but we have to bear in mind that although inflation will be quite helpful for government debt, if rates have to rise to control inflation, that has an impact on things like the discount rate you're using to analyze real estate. It has an impact on the relative value of real estate vis-a-vis other asset classes, credit, fixed income, etc. So it's not necessarily a good thing. And one would have to think very carefully around the types of assets and the types of occupiers in which who are providing the income for your assets, to think about, is there a natural inflation hedge? But more importantly, I think this is where it gets really interesting, is we've talked a lot about these structural trends and shifts, whether it's data centers, aged care, living, built to rent, etc. The changes in retail. And actually what that's doing is changing, I think, how we think about real estate. What is a lease? How are turnover rents going to work going forward? And is the industry completely teed up for that? And embedded within that, shorter leases, more focus on turnover. Actually, the cash flow there can have a bit more, I think, of an inflation hedge, because you might be resetting in some assets what the underlying income looks like, and that can have, I would argue, more of a hedge against inflation than perhaps some of the longer lease aspects, unless of course they're RPI or CPI, etc. linked. So I think absolutely it's a concern. I don't think it's an immediate concern. I'm more concerned about actually where yields are in some asset classes, and the amount of sea of liquid money that's flowing into real estate and real assets. But again, I think with some of the structural shifts in the market, there will be more elements of real estate today than there were 30 years ago that will provide more of an inflation hedge. I know there's lots of other people have a view on that, but Roland, on the debt side, etc., I'm sure you've got some opinions on the inflation side.
Yeah, I think if you would assume that, yes, there are considerations of inflations, but I think the baseline assumptions in the market at the moment seems to be that this seems to be still contained in the medium term. I think, and it does not ultimately affect the main reason of the attractiveness of, especially of real estate debt in the scope of institutional investors. I would define that the big five why to invest in debt are still valid despite inflationary trends, and this is number one, I think the attractive liability match that especially long-term fixed rate loans can provide for fixed income investor. The aspect of yield enhancement. Now, if you invest in debt in the space of core plus, value add, transitional assets, value add assets, which from my perspective will also come more and more into play in the office side, particularly. You can generate yields of 3.5% to 5%, something that you will equivalently only and rarely find in the prime core space on the equity side. Spread over benchmark, already mentioned as part of our discussions today, with long and short-term yields still very, very low. I think the play of a spread over benchmark alongside the risk curve being somewhere between 2 and 4% is still very attractive. Then the fourth aspect is the attractiveness of debt being for many asset managers, but also for many investors, becoming more a strategic investment tool. So debt acting as a front runner to get first footprint into a dedicated new market, a complement, so to say, to equity positions, or sometimes even a substitute if markets and prices are a little bit off the table on the equity side. That still allows to be active and to remain invested in the space of real estate by way of debt. And last point, point number 5, I think, which has proven to be very convincing during COVID, it's the resilience. So with very little impairment so far, ultimate write-offs. Of course, this is also supported by the big diversification and the variety that we now see in the debt market. There were some questions from the audience concerning distressed and loans and fire sales. A question from Moise and from Roland. We haven't seen too many of them, a point that already Michael did earlier today. But even if there were more to come, nowadays, the market of debt is so broad, so diversified. There are so many tools, funds, who could at a given point of time take up those financing and refinancing needs if they occur, so that I'm pretty confident that now debt has become so large, so diversified, and so broad, alongside a big spread of players, banks, non-banks, debt funds, and institutional lenders also increasingly position themselves directly, not only as secondary investments, but direct counterpart to borrowers, that I'm not too much concerned about the attractiveness of debt as a whole beyond the next years to come.
Thanks, Roland, and thanks for picking out those 2 questions as well. I think that's great. I guess finally, I wanted to get each of your views of how the CRE market will look like. I mean, I know that we touched on it a bit earlier from a tenant, landlord, and lender's perspective, as we adapt to this phrase that everyone keeps saying, that could be somewhat annoying, this new normal, as we like to say. Roland, what would you like to give your perspective on this?
Yeah, just some add-ons. I think Europe, remaining in the European perspective, of course, remains a very liquid market with a huge presence of banks still active in the space. We haven't seen banks withdrawing from their positions, neither in their domestic markets nor in the cross-border activity, unlike the situation that we had 10 years ago. So the market remains very, very broad, very diversified. What has changed, I think, is the accessibility for borrowers to non-bank lenders directly. I think this is quite beneficial. It's beneficial for us as borrower, because we can, directly exchange with borrowers and directly set up credit structures convenient for both parties. And the scope of choice that now a lender has and a borrower has significantly increased. I think the scope of parties that are conducted directly with each other I think will provide a lot, next to, I think, the ongoingly low interest rate environment, will provide in the long run a lot of stability and diversification to the market.
Thanks, Fred. And Michael, what about you?
Well, so to say, to sum up and also give a bit of an outlook, so to say, I do think that the increasing competition for top assets, with just the pressure on investors that most have, like I think Larry touched upon it, the general investment volume has been lower, so they are behind in their plans. They couldn't buy everything they planned in 19 to acquire in 20, and now the run, again, like Larry said, if there's 20 people bidding for a 900 million portfolio of logistics, that means there's a desire to invest 18 billion, and therefore competition is increasing, and you have to more or less, and no one wants to do that, but to not necessarily always be on the lookout for, can I get the best product, but can I get the least worst product that is still acceptable and will allow me to give and produce sustainable returns. Obviously, all aspects, and like we touched upon earlier in DD, you turn around every stone 3 times now. What we do also see, and I think we will continue to see, is just an increased specialization and of investors and products. So niches are popping up, market segments. Is it new funds that are brought into by large players for very dedicated to, for example, I mentioned earlier, data centers or hybrid versions of asset classes. So we have a couple of newer asset classes, like data centers. We have the lines are beginning to blur between the classical asset classes. There's what is core office. Can I combine it with? 2 years ago, we would have said hotel. Now hotel not so hot, but in general, I think also once there is a reasonable level of vaccination and travel is possible again, tourist destinations will pick up first, and eventually business travel will follow again. And these are just the general assumptions that we had over a year ago, when it's like, okay, do we have a glass ball? How will the office look? Like we see here on the panel, people fortunately are back in the office and will be coming in, and lots of people want to come back. So the office, the death of the office that has been promoted by some industry players, but very early in the crisis, they had to revise their opinion. It's really not coming. Other than that, again, I think we all and investors had a time, and were forced to, but also were allowed some time to really think about every single aspect of their approach. Who are we? Who do we want to be? Where do we see ourselves in? And like a classical job interview question, where do you see yourself in the next 5 years? These assumptions had to be reevaluated and reevaluated. I think some are not done, or you have to kind of reinvent yourself to keep up with the market and specialize. But in general, I mean, there's so much, a wall of cash or a wave of cash, or somebody said it earlier, that is just needs to be invested. So we will see a bright future for commercial real estate at the end of the day.
I like this positive outlook. Neil, what about you?
Yeah, I think I started off the session by saying there was a really fascinating time for real estate, and I'm not absolutely being. This is a phenomenal time, I think, for the asset class. And a couple of points I would make, I think, are really important. We shouldn't lose sight of, again, financial basics. Look at where govies are. Look at that tsunami of capital. Yields are going to get tighter. Valuations are not suddenly going to drop off a cliff. I think we need to remember that real estate is entirely linked to the built environment and to humans. And there's a lot of technological change happening, accelerated by COVID, that are really going to play out across the industry over the next 5 years. And this industry, I think, is going to become much more intensive on the asset management side. To Michael's point, much more specialist, and will have to be, I think, a lot more innovative as well. So that will change how we think about the industry. And finally, I think we'll talk a lot more about customers and not just occupiers and tenants, because we're going to have to persuade people to use the buildings that we create to work with us as real estate investors. So to sum up, fascinating time to be coming out of a global pandemic for real estate.
Thanks, Neil. Let's close it up with Larry.
Thanks. Well, so we certainly are going to have an increase in investment volumes. I think that's sure, because they went down over 20%, and we're already seeing a lot of stock out there, a lot of more investors able to travel, confidence coming back into the market. So I think there will definitely be an uptick there. And the debt side, I mean, I think obviously sort of Roland and Neil are probably more specialised on that, but we had a quite an interesting conversation yesterday where about probably sort of 10 years ago, there would be fewer lenders in the market. So the debt market would take longer to catch up with the investment market. But now there are so many more and sophisticated lenders in the market that as soon as these trends change, and some of the trends we mentioned before, potentially investors going back to look at retail or look at other markets, the debt market should, or some debt markets should still be there. Also, I totally agree with what Neil says. Fascinating time to be in real estate, because the whole of the asset classes has completely sort of changed, and you will definitely get more specialised investors into these asset classes. And I guess also, developers really looking at what they're going to do with a project, with a building. A lot more mixed use, a lot more hybrid. Developments that will mix the office with the potential hotel, with potential co-living, with some potential with retail as well, instead of just the kind of office areas and business park areas. So I'd say a fascinating time to be here. Certainly a lot of positives, a lot of investors coming back to the market, different kind of waves of global capital. 20, 30 years ago, it was the US and then the Germans. Now we're seeing a lot more of the Asians. We're seeing French cross-border investors that used to just more be just in France. So I guess new capital and a lot more sophistication, a lot more asset management, and a lot more sort of specialized in these new sectors that have been evolved due to the current situation. And I guess, the only maybe sort of clouds on the horizon are if interest rates do rise quickly, if there is other knock-ons from this pandemic. I agree. I think investors have to look at the fundamentals as well. And when you see some of the yields down at the levels we're seeing, we've never seen before, then there might be question marks on that. But generally positive and looking to get back into the office more.
Thanks, all of you. I mean, I don't know if you can hear the bell ringing again, but we're on the dot. I'm super impressed. The hour's actually flown by. I really think the conclusion is actually people are being creative and overall positive. I can't thank you enough for your time, panelists, for preparing also together. Had really, it was really informative from my perspective. And thank you for all the attendees in participating and having so many questions. I look forward to hearing from you all and wish you all a really good day. Thanks a lot.
Thanks, Magali. Thanks for hosting.
Thank you.
Bye.
Cheers.